All right, guys. Let's give it a minute for some people to hop on. I'm going to end up moving my screen, and you guys should be able to see. Everyone just went live. Link above. All right, so what's up, guys? Pretty wild day. In market, fully recovered. I jokingly posted this morning when I had my spy calls that I was going to go ahead and close them out, and that everyone should wait 15 minutes because as soon as I close them out, the market's going to run. And it did that. We recovered into close. So we'll give it like a minute for some people to hop on. I think the live stream is public. Did I make it public? I did. What I want to do in this video is just kind of go over the market like we normally do. And really want to talk about hedging. I try to keep simplicity within this channel and within our Discord community, as try to keep things as simple as possible. The furthest complexities that I ever really get into is like selling cash secured puts, covered calls, and spreads. The reason that I try to keep simplicity as much as I can within the Discord is that normally for a new trader, a lot of this shit will just overwhelm you. And also too, a lot of what we're going to talk about today does require having a bit more money, not a ton of money, but a bit more money. And depending upon how dynamically you want to actually hedge your position, you might have to have PDT rule removed. So hit the like button. We're going to go over Tesla. We're going to go over everything. But I want to talk about hedging and dynamic hedging specifically. Hedging is something I've done for a very long time and that I recommend like 90% of you guys to do. I just picked up the book Dynamic Hedging by Nassim Taleb. I highly recommend you guys read it. But hedging is something I've always done. But a lot of what he talks about is neutral delta. Which, does anybody here know what like neutral delta trading is? A lot of market makers use neutral delta trading because they have to in order to keep their portfolios neutral. And to not bring on like a shit ton of risk when they're filling orders. So a lot of what he talks about is neutral delta trading. A lot of what I end up doing is hedging with half of a delta. I barely understand delta. All right, let's talk about delta then. This will be the first thing. I plan to make a standalone video about delta and about what we're talking about today. So if this gets like long and redundant, the reason I want to do this type of live stream is simply just because I feel that when you guys have the ability to ask questions live, it's just better for teaching you guys. You know what I mean? So that's the most important thing. I need to actually remove this off of my screen to make sure you guys can't like, I don't think anyone can see my account numbers. Can I do that? Account and security. We'll see. I don't know. Hopefully you guys don't see my account numbers, but I want to be able to talk about this on like a real options chain. But what I was saying before is that when you are trading any options, you should always have some sort of hedge in place. And that's what I try to really focus on. You could have a hedge in place by doing like, for instance, a call credit spread or some sort of spread. This is one way that you could do a hedge. You could do a hedge with shares, which is what we're going to be talking about right now. And we're going to be talking about, you know, you guys have probably seen like put credit spreads and also selling cash secured puts, which is something else that would be considered a spread. I want to lock this. No, I don't want to work that. I want to make sure that you guys can't see my numbers. I don't care if you guys see the account. I just want to make sure that you guys can't see the actual like account numbers and shit. Like, can I hide it? Hide your broker ID. All right, there we go. That's what I want to do. Okay, cool. All right, let me talk about this. So I opened up this Webull account to really test this with you guys. And right now, currently, we have about $44,000 in this account. And my goal is to focus a lot on like volatility, neutral delta trading, and then also just to kind of like have you guys follow along with this on a smaller scale. We're going to talk about Ulta as one of the positions today, which I currently have a put position in, but I removed a huge part of the hedge by buying, you'll see, by buying shares, which is what I want to talk about in this. But let's talk about delta first. Does anybody know what delta is? I know it's a Greek, but does anybody know what delta represents? Or does anyone not know what delta represents? Sorry, this is like overwhelmingly hard to, there we go. So let's look at calls and let's just go for Apple. This will be like relatively easy if we keep it this way. Oh, if we see your numbers, don't worry, we won't tell. Thank you. Delta neutral describes the related financial securities in which the portfolio remains unchanged when small changes occur. Exactly. And when you're delta neutral, you're really focusing on volatility. So volatility, like you'll explain when we talk more about delta neutral. In this, delta is the amount the derivative value changes when the underlying value changes. Does anybody know what a derivative? Now I'll do that in a different video. What a derivative is. Basically, a derivative is just a financial instrument that changes off of the underlying. So an option would be a derivative because if the underlying moves, that will move. That's what causes, you know, the derivative to move. So this is the call side of Apple. So I'm going to go through and just like remove this. I don't really know how to use Webull. So if you guys can explain to me, it'll help me a lot here. But looking at Apple, you guys can see here that this is our delta. And currently we're going to be looking at September 16th calls. So if we're looking at September 16th calls and we look at the 157 call, I'm actually going to open up. I'm not going to open up Epic Pen. It's too much of a bitch to do. Hit the like button too. You guys can see here that when we're looking at this 157 call for September 16th, our delta right here, the delta currently is 0.49. You can add 0.6. When you're looking at the delta, it's 0.49 and you would times that by 100. So the delta is basically the amount of money you will make for how much the underlying stock goes up. So if Apple goes up $1, you will make $49 owning this contract. Okay, so if Apple were to go to 157.83, as of right now, this contract, you would make $50. So if you own 10 contracts, you'd make $500. If you owned 1,000 contracts, you would make $5,000. Does everybody understand that? The delta is how much you will make if the underlying goes up by $1. If you do not understand that, please let me know and I can go over it again. Okay, you guys know. 49 cents per contract. Each contract's 100 shares. Exactly. So you would do 49 times $100. So does anybody know what the delta of one common share of Apple is? Does anybody know what the delta of one common share of Apple is? I know for some people this is probably like a little more advanced, but I feel like it will really help even if this live stream doesn't get a fuckload of views. I don't really care. So a common share has a delta of 1. Exactly, MMT. So a common share has a delta of 1. So this is equivalent to owning 50 shares, basically. If we were to get that call, right now it's equivalent to owning 49.5 shares of Apple. That's how much money you would make. So the way to hedge this, and we'll look at a put. So let's say that you think Apple is going to go down in the next couple of days. Really, we should go with like something further out of the month. Like let's go like October, just because we have more time. So if we look at October 155 put, our delta is minus 0.42. So that means that for every dollar Apple goes down, we will make $42.50. Everybody understands that. When you're looking at puts, it's going to be a negative delta. If a share changes $1, the share changes $1. It's a 1-1 on itself. Yes, exactly. So it's going to have a delta of 1. So if we're looking at the 155 October 14th puts, Apple will go down. If Apple goes down $1, you make $42 because you're betting against the stock. Okay? So the way to hedge this, and the way that I hedge this, is if you want it to be actually, let's do this. If you want it to be delta neutral, what would I have to do to become delta neutral? We know that our delta is minus 42. So we're minus 42 delta in our portfolio. And we know that one share is a delta of 1. So if we're minus 42, how do we get back to even? If we're minus 42 delta, how do we get back to even? So buy 42 shares. Yes, because it's a delta of 1. So if we had a 42 minus 42 delta, we would buy 42 shares. Okay. Now, within our Discord, for any of the premium members, I entered a position on Ulta today. And I want to explain basically what I ended up doing for this. Now, that would be if you want to be delta neutral. And I will probably make a separate video, or we can talk about that if we have enough time today on why you want to be delta neutral. But for anybody who doesn't know what a market maker is, does anybody not know what a market maker is? Market makers have to be delta neutral at all times. So a market maker in layman's terms is basically going to facilitate every transaction. So if Ergo wants to buy a 155 put on Apple, since I'm a market maker, I have to sell him that put. Well, now that I sold him that put, I'm positive 42 delta because I'm selling a bearish position to him. So now I'm a bull. So I'm positive 42 delta because he's negative 42 delta. So the only way for me to become delta positive or delta neutral is how would I do that? If I am plus 42 delta because I sold him that bearish position, what I would end up doing is I would short 42 shares. So now my delta is even. And that's how market makers facilitate deals, right? Let's look at it with like something like Tesla. If we did like a September 16th put and somebody wanted to buy a 273.33 put, our delta is 46. So if I sold somebody this Tesla put, I'm positive 46 delta. I have to buy, or I have to short 46 shares of Tesla because I'm a positive 46 because I sold those shares, or I sold that option to Ergo. Okay. So we'll talk about delta neutrality and being delta neutral later. But if you're somebody who wants to hedge against a position, one of the easiest ways to do this is to always keep your delta at half. Okay. So we'll use Tesla as an example right now, and then we'll talk about like an actual position I have open in Ulta right now. And I think that by the end of explaining how to hedge like this, you guys will say, well, why don't you just buy half the amount of shares or half the amount of puts? And we'll explain that. So we're looking at September 16th, Tesla. I probably should rebalance my position really quick too, but we'll do that. It's whatever. I'll do it tomorrow. So let's take a look at the September 16th Tesla 273.33. Let's do calls. 273.33 calls. No, we'll do puts. It'll be easier. 273.33 puts. Let's say that you're bearish on Tesla right now and you want to buy some puts, but you want to hedge properly. What you would do is look at the option. We're not going to talk about IV or gamma or theta or anything right now. What we're going to do is we are going to buy one of these puts. I'm not going to actually do this, but what I would do is actually buy one of these Tesla puts. And now our delta currently is 46, which means for every dollar that Tesla goes down, I will make 46 bucks. So if I were to buy this put completely naked and Tesla drops $1 in the next minute, I'll make 46 bucks. Okay? That's what your delta is signifying. Now, what I want to do to hedge this position, since I have a negative 46 delta and I want to be at half, how many shares would I buy? So if I'm at a negative 46 delta, half of that would be 23. So I'm at negative 46. I'm going to buy this put, and then I'm also going to buy 23 shares of Tesla. And what that will do is that will hedge my position. Now, let's say I come back, let's say the stock drops and we come back and now my delta, you can see right now, our delta is at 48. So let's say the delta goes to 40. Well, now I have 40 delta on the position, minus 40 delta, but I own 23 shares. So now I have to rebalance my position. What would I do to rebalance my position to stay at a delta half state? So now the delta dropped to 40. What would I have? Because the stock went up. So what would I do in order to keep a delta even state? It'll be a lot easier when I show you guys a position that I'm in right now that will help explain this to you a bit. I would have to sell 3 shares. So I would have to sell 3 shares because now my delta's at 40. I own 23 shares. Selling 3 shares would keep me at half because my delta's minus 40 and I would have 20 shares. So now if the delta goes back up to 50 because Tesla drops, what do I have to do? Well, I have to rebalance and now I have to go buy 10 more shares. And so what you're doing is multiple times, theoretically, the best way would be multiple times per day, you are buying and selling shares to keep yourself delta halved. And if you're a market maker, what you would do is buy and sell shares to keep yourself delta neutral. Okay. So let's look at an example right now. Could you type these numbers on a plain text document? That's a really good move. Yeah. Yeah. How do I do that? Is there like, hold on, Grammarly. New. All right, let's do this. All right. So if we have Tesla puts and we are minus 46 delta, to hedge correctly, we want to half our negative delta. Okay. So the way to do that is Tesla put is minus 46. And then you're going to buy 23 shares. So Kenneth says, man, this means you have to be at your computer at all times. So true. And also we'll talk about this. So there's a standard hedge and then a dynamic hedge. A dynamic hedge is continuing to balance like we're talking about right now, where a standard hedge would be you just buy 46 puts or you buy one put contract for a minus 46 delta and then you buy 23 shares and you just let the trade move. And what that's going to do is that's not going to protect your downside as hard. And you'll see this in a minute. So this is what we'd have to do. And then if Tesla goes down, so let's say Tesla goes up because we have a bearish position. So if Tesla goes up, the delta becomes 40. And now we have to sell 3 shares to have 20 shares, which is going to be half. But then let's say Tesla rips and it goes, Tesla dies, I should say, because we're against it, dies, and the delta goes down, or goes down to, it'd be a 50 delta. Now we have to buy 10 more shares to give, or I'm sorry, 5 more shares. 5 more shares to give us 25. And so basically the shares are protecting your downside in the trade at all times. So I want to use like a real world example right now. And we'll talk about this within our Discord. So within our Discord, I took a huge trade today on Ulta, and then I took 1/20th of the size on Webull, which is what we're going to talk about in a moment. But I said today I'm testing out a dynamic hedge on Ulta. It looks like we should fade here. I bought 10 Ulta 916 415 puts. The delta on these is minus 466. So the delta would have been minus 46, but I have 10 contracts. This means to hedge the delta by half, I have to buy 250 shares basically, and that will help to cut the delta in half. And I bought 250 shares at 416. You said it, buying the shares or selling the to protect your options regardless of the call or put. Exactly, yeah. So I said I don't totally recommend this. It's going to require a lot. I said I'm going to do a video messing with this. So let's talk about the position itself. I don't really know how to use Webull that well. because I just started this, but we'll fuck around with this a bit and hopefully this will help you guys. So currently on the position, with what I'm holding at this very moment, I am down $163.36 on my Ulta bearish position. Okay. So I'm down 163 bucks, but this is not actually how much I'm down because I've been selling and adding shares for a bit. And we're going to talk about this in a moment. So let's go back to the home and let's take a look at what I actually did. So you can see right here, what I ended up purchasing, I'm going to go through and do this, is I ended up buying an Ulta. Let me get on my phone too, so it'll just be easier. I know how to work the phone version. I feel like a fucking boomer right now. But not that that's a bad thing. So currently I bought today one Tesla or one Ulta put. I bought a single Ulta put. You can see this right here. The limit price was $340 and I filled at $340. Now, at the time, like I said, at the time the delta was minus 4.6, which means I would have had to buy 23 shares of Ulta. I bought 22 shares of Ulta to hedge. So this means obviously now my delta is no longer minus 46. My delta is 22, which means I'm going to make less money on this position. But I'm going to have those shares in case the stock rips and my put is getting killed. My shares will help to offset that loss. Does everybody understand that? I bought a 415 put on Ulta, and then I grabbed 22 shares of Ulta as a hedge. So after a bit, Ulta did the opposite of what I wanted it to do. I was hoping we were going to reject it 417, and what happened was instead we pushed through. So now what this is going to do is make my shares worth more money. Okay? It's going to make my shares worth more money. But it's going to hurt my option. So what did I do? All right. I said sold 30 shares of Ulta, but this is on a different position. So what I did was, because my delta went from 46 to 44, I ended up selling 5 shares. So you can see here, I sold 5 shares to even out my delta. So I sold 5 shares because my delta went down. So when we ended up doing this, what ends up happening in this instance is I ended up buying those shares initially for $4.18. I'm sorry, I ended up buying those shares initially for $4.16. You can see here, average price, $4.16, 22 shares. And then what I did was I sold to keep my delta even. I sold 5 shares at $4.18. So basically I made $2 per share. So I sold 5 shares and I made $2 per share, which would give me a profit on those shares of $10. 5 shares. Okay. Then Ulta continued to run. And so what I did, in order, because my delta went down, in order to match my delta, I had to sell 9 more shares. So I sold 9 more shares, and now that average price was $4.23. So I bought those shares initially at $4.16, so $416. And then, so we sold them at $4.23. So $4.23 minus $4.16 means we made $7 per share, and we sold 9. So 7 times 9 means I made $63 that time. Profit of $63 on 10 shares. So as the stock is going up, I have to continue to sell the shares that I bought, right? Because I have to keep the delta at half of what the option is. So now at this current moment, I have this Ulta position, this Ulta put, and the Ulta put that I currently have, the delta is at 27. So the delta in the single day went from 46 to 27. So 27 divided by 2 means that right now I should have about 13 shares of Ulta But because I've been on this call, or on this stream right now, I currently have 9 shares of Ulta. So I should have bought some more shares. So as you can see, I'm betting against Ulta, and as the stock goes up, I'm buying more and more and more and more shares. And as the stock goes down, as the stock's going up, I'm selling shares. And as the stock going down, I'm buying more shares. So at this moment, I am currently down. We'll go back to Ulta. At this moment, positions. There we go, on the right side of the screen. So at this moment, I'm down $151 on Ulta in total. I am currently up $33 on my shares, and I'm currently down $185. So I actually need to buy 4 more shares in order to keep this even. So I'm going to go buy 4 more. We'll just hit a fucking market. It doesn't really matter. Why can't I buy 4 shares? Oh, this is for the contract. Okay, I'm going to have to actually like go to Ulta itself. I don't want to buy more contracts. It's ULT, not Ulta, dude. See, there you go, bro. Ulta. There we go. So yeah, we'll go buy 4 more shares. And this will bring me up to 13. And we'll hit a market. And that'll be $1,600. And so now in total, we're going to have about 14 shares. So what you guys are going to be able to see is that as the stock is going up, I'm going to be selling out shares for profits. And as the stock is going down, I'm going to be buying shares cheaper and cheaper. And so if we look, I'm down $150 in total on what I'm currently holding. But I ended up closing $63 profit on those 1 shares and $70 profit. So net, I'm only down $70. And if you look at what happened with Ulta since I entered that put position, it's ran 2%. So net, I'm only down $70, but if I would have just held my puts, I'd be down $200. Does everybody understand that? And we're going to talk about, somebody said, how about you just do half as many options and forget about the stock? All right, that's a good move. We'll talk about that in a minute, Daniel. That's a really good question. That's what a lot of people say too. So instead of being down 190, I'm down like 75 or $80 because I'm constantly rebalancing this, which is a bitch. Now, like I said before, you can just go ahead and you can just enter with your hedge. So if the delta was negative 46, you could just buy 23 shares of the stock and you would end up having that hedge set up. But it's not going to allow you to make these incremental wins every single time that the stock goes up and the stock goes down, because I'm constantly buying and I'm constantly selling on the way up and the way down. So tomorrow, if this thing were to eventually push its way up to 425, I'm going to be selling all the shares I bought up at 425 as that delta gets lower and lower, right? So this is how you would end up hedging out a position in the correct manner. Now, going back to what Daniel was saying, how come you don't just buy half the amount of options? Does anybody know that? Why would you want to in a preferred way? This is what, first of all, hedge funds are doing. So if you have a small amount of money, like if you got like $800, like you're not gonna be able to do this. But why would we want to do this over just hedging via buying half of the amount? Because you got money. Yeah, no, but why would we want to do this? Why would we want to end up doing this over just buying half the amount? Think about it. What does an option have that the stock doesn't have? Okay, higher potential for higher gains. Yes, no theta decay. Let's go, modern money. Yeah, so Daniel, if we were to just buy half of the amount of options, we would still deal with theta decay. So like if Ulta had a ton of volatility to it, we're going to lose all of our money, versus if Ulta, getting those shares as a hedge, there's no theta. So let's say like we end up going up and then sitting sideways, like we're not gonna have to deal with theta decay as much. Now you can just hedge by doing like a call credit spread or a put credit spread, right? Now the beauty by this, and this is where like it's gonna start getting fuckery-ish, and I don't really want to go through that now, but we'll talk about this in a separate video, Because I also do want to draw, like somebody asked me if I could draw this out, a risk profile chart. Yeah, that'd be phenomenal. That's what I need. So the beautiful aspect of this is that when we're looking at an option, implied volatility is fucking everything. If implied volatility gets higher, it's going to move the price of the stock. So the reason that we have this set up, now this is a good question to you guys, okay? Why would we do this over getting like a call credit spread? If we're bearish on Ulta, why would we do this over getting a call credit spread? How come 200% IV options seems better than 20% IV options? In what way? I mean, so like if a option has 200% IV, like I'm going to be selling cash secured puts on it or covered calls on it or doing some sort of call credit spread on it just so I can collect the theta decay and then collect the premiums. But why would we do this over just, you know, going through and focusing on potentially just getting like a call credit spread? Why would we do this? Hit the like button. I know this is a lot. I know for some people it's probably like, what the fuck is he talking about? Why would we go through all of this? Because we still have theoretically unlimited gains. Right? We still have unlimited gains. If Ulta went bankrupt tomorrow and the stock fucking cratered, right? Like, I am going to end up losing, what are my shares worth? So if the stock craters tomorrow, I will end up losing $5,000 in shares. But my contract could be worth 20, 30, 40 grand. If Ulta went to zero tomorrow, right? Because we have that put, we still have unlimited upside potential. We would lose $5,000 in shares, but we would make 20 grand on this option. Well, I mean, to look at it this way, let's actually find out how much we would make. The delta right now is 27. So 27 times $420. We would make $11,390 if Ulta went to zero tomorrow. And we would lose $5,000 in shares. Now, if we got a call credit spread on Ulta and Ulta went to zero tomorrow and we got a premium of $200, we'd only make $200. Right? That's where we still have our unlimited upside potential via the option, via the put, but our shares are giving us a hedge. To whereas if we did a call credit spread, we do not have the unlimited potential. And if we were to just get half of the amount of options, we still have to deal with theta decay, destroying our position. Right? So if we look at Tesla as an example, and let's say you think that Tesla's going to go down, and you look at the September 16th puts on Tesla, and let's look at it this way. Let's look at the 276.67. Let's say Tesla goes down $25 tomorrow. For every contract that you control, you will end up making $1,200 tomorrow if we were to gap down that. But if you were to do like a call credit spread on this, you would end up maxing out at whatever your premium would be, right? Like we could do this right now, but if we were to get a call credit spread at the money and we were to do like a vertical on it, and we were to sell a call credit spread at the money, you would only end up making $95, which is not going to help, right? It's going to require less money, which is great, but it's still not going to help. Sounds like a clever sort of portfolio diversification. Yeah. And this is portfolio management. And I talk a lot on this channel. Like, I don't know if you guys hear me. Like, I don't like the name traders helping traders. I hate it. Because 95% of traders lose their fucking dick and their ass and everything that they have, right? We all know the horror story of somebody losing everything. And it's simply because everything that people are teaching is a losing game. Like, buying straight up calls and straight up puts is usually a losing game over the long run, over doing it for 5, 10, 15 years. Which is why I don't do that. right? Like a lot of the money that I've made and most of the money I've made via trading is usually through selling cash secured puts or taking some sort of options with a hedge. But it's hard to talk about on YouTube because it requires so much dedication from the viewer to actually want to learn to be a portfolio manager and to trade derivatives correctly. And that's what makes it very, very hard. Because, like I said before, not a lot of people want to do it. So, guys, I hope this helps. I'm going to do a normal Tesla video later. I wanted to talk more about Tesla, but we kind of got sidetracked with this, and I feel like it's very important. I doubt this video is going to get a lot of views, and to be quite honest, I really don't give a fuck about views at this point, and I don't really care about views on this specific video. What I want to start doing, though, is really putting 2 to 3 videos out on Tesla a week, and then talk, maybe 4, and then start doing 2 or 3 videos like this. Not this like in depth, but making them like in depth, but like talk very specifically about one position. And I'm gonna start teaching you guys. I haven't done a lot of teaching on here. A lot of that happens in the academy, but like I want to teach you guys the right way, because not a lot of people talk about this shit, and a lot of people are around for just getting views and getting hype. But I really want to end up teaching you guys how to do this correctly, because the people who do this, right? The people who really focus on this, they don't share it. Like, you know, you're only gonna learn a lot of this if you're fucking reading a ton of books or you've been trading as long as I have. How much is the academy? The academy's $149 a month. You get access to all the courses, but if you just want access to my trades, you just go to the Discord in the description, and I do a lot of teaching over there as well. And you can just go over to the Discord and then go to the upgrade section. You'll get access to all the trades and whatnot. Both those links are in the description. I learned something new today. Fuck yeah, let's go. A risk profile chart will help. Yeah, I need to open up my TD Ameritrade and do that one day. I think you can do a risk profile on there. Make sure you guys hit the like button. I know this was hard to like go through. MT top, 6 months in the market. I haven't heard this level of teaching. Thank you very much. Better yet, how much for a one-on-one? It's $2.49 an hour. Shoot me a Discord message. But before you do that, I'll send you over a questionnaire. Because I want to make sure that when you pay for a one-on-one, like we're getting exactly what you want and exactly what you need. And like, it's to the fucking T, right? I'm not one of those people, like I want to keep you on the phone as long as I possibly can to like juice fucking money out of you. Like I want to make sure that we're using your money and my time to the best of our ability. But my goal is to make a lot of these. And what I'm going to do is I'm going to start making like very basic technical videos and very basic options videos that are like 5 to 6 minutes long. And I'm going to put them in a playlist so you guys can watch them. $2.49 an hour. So $249 an hour, shorting the trend. But yeah, so I'll probably put a Tesla video out today. I hope this video helps. You can go back and rewatch it. And I'm going to do a standalone video on this. That's going to be like edited and less like, I guess like hard to watch, but we'll see. Guys, have a good day. I fucking love you. Peace.